Imagine unlocking the secret to protecting your wealth in an era of economic uncertainty. Is Bitcoin still the ultimate shield against inflation, or has the narrative shifted? Today, in 2026, with Bitcoin trading around $67,000 after a wild ride, we're diving deep into whether BTC holds its crown as an inflation hedge. Stick around for fact-backed insights from top sources that could reshape your investment strategy. And for 100% true news and correct advice like this, like the video, subscribe to Joseph Markets, and comment Joseph Markets below. It fuels more verified content tailored for smart US investors. By the end, you'll have a clear verdict on Bitcoin's hedge potential, plus actionable tips. But first, let's unpack the basics. Is Bitcoin still a hedge against inflation? Research suggests Bitcoin may serve as a partial hedge against inflation over the long term due to its fixed supply and historical outperformance. But evidence from recent years shows it often behaves more like a risk asset, correlating with stocks and underperforming during high inflation periods. It seems likely that while Bitcoin's scarcity provides some protection against currency debasement, its volatility and ties to broader market sentiment limit its reliability as a consistent hedge, especially in short-term economic turbulence. The evidence leans toward viewing it as a speculative asset rather than a straightforward inflation shield, though proponents argue ongoing adoption could strengthen its role. Key insights: Bitcoin's capped supply of 21 million coins and halving events create built-in scarcity, potentially preserving value better than fiat currencies. Historical data indicates strong long-term returns, but short-term performance has been inconsistent, with drops during inflation spikes. Comparisons to gold highlight Bitcoin's underperformance in recent crises, suggesting it's not yet a proven safe haven. Expert views are divided, with some seeing it as a hedge against both inflation and deflation, while others note its failure to decouple from risk assets. Understanding inflation hedges. An inflation hedge is an asset that maintains or increases value when purchasing power erodes due to rising prices. Traditional examples include gold, real estate, and commodities. Bitcoin's proponents claim its decentralized, limited supply nature makes it digital gold, but real-world data shows mixed results. Recent performance context. In 2026, with US CPI cooling to 2.4% in January, Bitcoin has traded around $67,000 $70,000, down over 40% from its 2025 peak. This volatility underscores debates about its hedge status. Balanced perspective. While Bitcoin has outperformed inflation-adjusted benchmarks long-term, e.g., plus 100% from 2015-2025 versus gold's plus 90%, it crashed 65% in 2022 amid 9% inflation. This suggests it's sensitive to interest rates and risk sentiment, but adoption by institutions could evolve its role. Defining inflation and the need for hedges. Inflation erodes your money's purchasing power. Think of it as a silent tax where $100 buys less over time. In the US, the Consumer Price Index, CPI, measures this, tracking a basket of goods. Recent data shows CPI at 2.4% in January 2026, down from 2.7% in December, signaling cooling but persistent pressures. According to the U.S. Bureau of Labor Statistics, CPI growth slowed to 2.4% year-on-year in January. This moderation has sparked debates on assets like Bitcoin. Why do we need hedges? During high inflation like the 9% peak in 2022, traditional money loses value as central banks print more. Assets like gold historically rise, preserving wealth. Bitcoin entered the scene as digital gold due to its fixed 21 million coin supply, programmed scarcity that mimics precious metals but with digital advantages like portability and divisibility. But is it delivering? We'll explore historical data showing Bitcoin's plus 4,100% return from 2015-2025 versus gold's plus 190%, yet question marks from recent crashes. According to FIBO Crypto, Bitcoin outperformed gold plus 4,100% versus plus 90% over 10 years. For everyday Americans, this matters amid ongoing economic shifts, from Fed policies to AI-driven changes. If Bitcoin hedges effectively, it could safeguard retirement savings. If not, it risks being just another speculative play. Stay tuned as we break down Bitcoin's design next. It's the foundation of the hedge argument. Are you hedging your portfolio against inflation? Comment your strategy below. And for more insights, like, subscribe, and drop Joseph Markets. Bitcoin's built-in design as an inflation hedge. Bitcoin's core appeal as a hedge stems from its protocol, a maximum supply of 21 million coins, unchangeable without network consensus. This scarcity contrasts with fiat currencies like the USD, where the Federal Reserve can expand supply, leading to devaluation. Satoshi Nakamoto designed it this way in 2009, post-financial crisis, to create sound money immune to manipulation. According to Bitcoin's white paper on bitcoin.org, the supply is capped at 21 million to prevent inflation. Halvings amplify this. Every 4 years, mining rewards halve, slowing new BTC creation. The last halving in 2024 reduced daily issuance from 900 to 450 BTC, with the next in 2028. This deflationary mechanic has historically driven price appreciation post-halving, as supply tightens while demand grows. For instance, after the 2020 halving, Bitcoin surged from $10,000 to $69,000 amid 7% U.S. inflation. According to CoinTracker, Bitcoin's price increased plus 590% from 2020-2021 as inflation rose. In practice, this means Bitcoin's inflation rate is currently about 1.75%, dropping below 1% post-2024 halving, far lower than USD's target 2%. According to Easy Blockchain, Bitcoin's declining inflation preserves scarcity. Over long terms, this has led to superior returns. From 2009-2026, Bitcoin averaged annual gains beating inflation every year. But short-term? Volatility reigns. Bitcoin dropped 65% in 2022, despite 9% inflation, behaving like a risk asset. According to the Motley Fool, Bitcoin plummeted 65% in 2022, as S&P 500 fell 19% due to inflation. For U.S. investors, this design offers potential as a portfolio diversifier, allocating 1 to 10% as suggested by experts. But does history back it up? Next, we'll travel back to Bitcoin's early days for proof. Historical performance, early years, 2009-2021. Bitcoin's hedge credentials shone in its formative years, outpacing inflation amid global crises. Launched in 2009 during the Great Recession, when U.S. inflation was low but quantitative easing flooded markets, Bitcoin's price climbed from near zero to $1,000 by 2013 as adoption grew. During this period, U.S. CPI averaged 1.52%. But Bitcoin's scarcity narrative attracted early adopters seeking alternatives to fiat. According to CoinDesk, Bitcoin's early rise was fueled by its anti-inflation design post-2008 crisis. The 2017 bull run exemplifies this. As global inflation ticked up with economic recovery, Bitcoin rocketed from $1,000 to $20,000, a 1,900% gain. This coincided with increased money printing, reinforcing its hedge status. Post-2016 halving, supply tightened, and demand from retail investors surged. According to investing.com, Bitcoin's fixed supply positioned it to rise against debasement. Then came 2020-2021. COVID stimulus injected trillions, pushing U.S. inflation from 1% to 7%. Bitcoin exploded from $10,000 to $69,000, plus 590%, as institutions like Tesla and MicroStrategy added it to treasuries. Paul Tudor Jones called it a great inflation hedge in 2020. According to CNBC, institutional adoption during 2020-2021 highlighted Bitcoin's hedge potential. This era solidified Bitcoin as digital gold, with correlation to gold rising since 2020. According to Fibo Crypto, Bitcoin-gold correlation increased, reinforcing safe haven status. Quantitatively, from 2015-2021, Bitcoin's returns crushed inflation. U.S. savers lost 31.5% purchasing power, while BTC gained exponentially. But cracks appeared. Bitcoin's volatility meant short-term losses, like the 50% plus drop in 2018. For long-term holders, though, it preserved wealth far better than cash. This sets the stage for the 2022 test, a true inflation stress test. Don't click away. The next section reveals why it faltered. Bitcoin aced early tests, but 2022 exposed flaws. For unbiased breakdowns, like and subscribe to Joseph Markets. Comment Joseph Markets. The 2022 bear market, Bitcoin's inflation. Hedge tested 2022 was Bitcoin's moment of truth. U.S. inflation hit 9.1% in June, the highest in 40 years, driven by supply chains and stimulus. If Bitcoin were a true hedge, it should have risen like gold, up 0.5% that year. Instead, it crashed 65% from $69,000 to $16,000, mirroring tech stocks amid Fed rate hikes. According to the Motley Fool, Bitcoin fell 65% in 2022 as inflation rose. Why? Bitcoin correlated with risk assets. Its beta to Nasdaq was high, and as rates climbed to combat inflation, speculative investments suffered. Liquidity dried up, with correlations to S&P 500 at 0.68. According to Investing.com, Bitcoin correlated 0.68 with Nasdaq, falling on tighter policy. Miners sold holdings, amplifying supply pressure. According to VanEck, miners sold Bitcoin amid tightened financing. Critics pounced. Warren Buffett called it rat poison squared, and data showed Bitcoin ignoring some inflation signals while reacting to others. According to Investing.com, inconsistent responses to CPI-PCE undermined hedge claims. Yet defenders note Bitcoin held above pre-inflation levels post-crash, and its network remained resilient, processing transactions without bailouts. According to KuCoin, Bitcoin declines during inflationary upturns, but rises when inflation slows. For investors, 2022 taught diversification. Bitcoin amplified losses in risk-off environments. But recovery began in 2023. Let's see how it rebounded. Recovery and boom. 2023-2025. Performance. Post-2022, Bitcoin staged a comeback as inflation cooled. From $16,000 lows, it climbed to $126,000 by October 2025, a 687% gain, outpacing S&P 500's recovery. This aligned with falling CPI from 9% to 3%, and Fed pauses on hikes. According to CoinTracker, Bitcoin's recovery was shaped by ETF approvals and halvings. Key drivers. Spot ETF approvals in 2024 brought billions in inflows, with BlackRock and Fidelity leading. Corporations like MicroStrategy held billions in BTC as treasury reserves. The 2024 halving tightened supply amid demand surge. According to Bloomberg, ETFs saw massive inflows, boosting adoption. During 2023 banking crises, e.g. SVB, Bitcoin rallied as a non-sovereign alternative. According to Fibo Crypto, inflows during 2023 SVB turmoil reinforced hedge status. Inflation adjusted, Bitcoin's 2025 peak was $99,948 in 2020, showing real growth but not parabolic. According to CoinDesk, inflation-adjusted high was under $100,000. Versus gold. Gold gained 64% in 2025. Bitcoin fell 26% late year, but long-term BTC outperformed. According to Investing.com, gold rose 64% in 2025, while Bitcoin fell 26%. This period revived hedge debates. Bitcoin decoupled somewhat from stocks, but volatility persisted. For U.S. viewers, this means potential in IRAs via ETFs, but with caution. Now to 2026's reality check. 2023-2025 was epic, but 2026 brings new challenges. Subscribe to Joseph Markets for updates. Comment Joseph Markets. Current situation in 2026. Is the hedge holding? In February 2026, Bitcoin trades around $67,000, $68,000, down 45% from 2025's $126,000 peak. Despite CPI cooling to 2.4%, Bitcoin hasn't rallied strongly, diverging from stocks. According to CoinDesk, Bitcoin fell to $68,000 despite weak CPI data. Outflows from ETFs total $8.5 billion since October 2025, signaling institutional retreat. According to Bloomberg, $8.5 billion ETF outflows reflect vulnerability. Macro factors. Fed's potential cuts, odds for 25 BP in March, could boost, but hawkish nominees like Kevin Warsh add uncertainty. According to Reuters, Trump's Warsh pick fueled rout. Bitcoin's correlation with SPX is declining towards zero. but it underperformed gold, up 61% yearly. According to Forex.com, BTC SPX correlation approaching zero. Deleveraging. Futures OI dropped 20%. Liquidations 3 Satur 4B. According to VanEck, rapid leverage unwind triggered sell-off. Positives. Whale accumulation of 53,000 BTC recently and stablecoin growth signal demand. According to Equity, whales added 53,000 BTC. But doubts grow. Bitcoin's utility as payments or hedge is questioned. According to CNBC, growing doubts on practical utility. For now, it's a mixed bag. Long-term hedge potential, short-term risk asset. Comparing Bitcoin to traditional hedges like gold, gold has been the gold standard hedge for millennia, rising during uncertainty. In 2025-2026, gold hit $5,500 while Bitcoin crashed to $60,000, with negative correlation and 0.27. According to Investing.com, gold rallied 3.5% on hawkish Fed news, while Bitcoin fell 15%. Why? Gold's physical scarcity and history versus Bitcoin's digital volatility. Data. Over 10 years, Bitcoin plus 4,100% versus gold plus 90%, but in crises, gold wins. During 2022 inflation, gold held steady, Bitcoin tanked. According to FIBO Crypto, Bitcoin outperformed long-term but gold has lower volatility. Bitcoin advantages: divisibility, satoshis, portability, wallet transfers, verifiability, blockchain. Gold's edge: tangibility, less energy intensive. According to Investing.com, Bitcoin to gold ratio at all-time lows. Hybrid approach: allocate to both, Bitcoin for growth, gold for stability. In 2026, with AI deflation risks, Bitcoin might hedge both ways. According to CoinDesk, Cathie Wood says Bitcoin hedges inflation and deflation. This comparison highlights Bitcoin's evolving role. Expert opinions and debates. Experts are split. Cathie Wood: Bitcoin is a hedge against inflation and deflation, citing AI-driven productivity drops, training costs 75% a year. According to CoinDesk, Wood argues Bitcoin thrives amid deflationary chaos. Contrarily, Motley Fool: not a safe haven, down 20% in 2026 versus gold highs. According to the Motley Fool, uncertain recovery amid shaky economy. Deutsche Bank: steady selling, growing pessimism. According to CNBC, Deutsche Bank notes declining interest. VanEck: macro bear, but fundamentals intact. According to VanEck, intact stablecoin adoption suggests stabilization. FIBO Crypto: best hedge due to scarcity. According to FIBO Crypto, limited supply preserves value. Investing.com: identity crisis, not consistent hedge. According to Investing.com, inconsistent inflation responses. X opinions: skeptics call it a zombie network with no utility. According to X post by Tietlev, every narrative collapsed. Proponents quote Wood: debates rage on utility versus speculation, potential risks and counterarguments. Risks: regulatory hurdles, like stalled Clarity Act. According to Seeking Alpha, regulatory stalls weigh on prices. Quantum threats, though distant. According to VanEck, quantum debates add pressure. Correlation with tech: behaves like NASDAQ stock. According to Investing.com, 0.68 correlation with NASDAQ. Counterarguments: long-term data shows outperformance. Adoption grows. No counterparty risk, unlike banks. According to CoinDesk, Bitcoin insulated from disruptions. In deflation, scarcity shines. According to KuCoin, rises when inflation slows. Future outlook: will Bitcoin evolve as a hedge? Predictions vary: 75K, 225K by year-end, depending on Fed cuts. According to CNBC, wide range for 2026. If easing aligns with fiscal policies, 110K, 140K. According to AI Invest, bullish if Fed liquidity expands. Bear case: further drops if stagflation. According to Investing.com, macro risks like stagflation. Evolution: more ETFs, nation-state adoption could solidify hedge status. Watch CPI, Fed minutes. For investors, DCA 1 to 5%, diversify. So, is Bitcoin still a hedge? Long-term yes, short-term cautious. For more, subscribe to Joseph Markets. Comment, Joseph Markets.